Thanks very much for your introduction. Just by way of background to Warehouse REIT, there was a big clue in the name. We came to the AIM market in September 2017 following a successful oversubscribed IPO. We're looking to raise 150 million, which was to fund a seed portfolio that had been put together over the previous 5 years by the management team using our own equity aligned with bank debt. So it was a way that we could continue to hold our interest in the portfolio and yet find a tax efficient structure, namely the REIT. So since IPO, we have been joined by the non-exec board of Warehouse REIT, all investing in a shareholding, and we now, together with the board, have just shy of 20 million shares, representing 8% of the REIT. So real alignment between management, directors, and the wider shareholder base. The REIT has a market cap of approximately 265 million. There have been 240 million shares issued, and we typically see trading volumes of between 300 and 800,000. I'm going to take you through a quick overview before handing over to Peter to look at the finances, who will then hand back to me to look at the valuation and asset management, and we will try and keep within the time frame to allow questions. So just very quickly, we refer to Warehouse REIT. It is externally managed by Tilstone Partners Limited. It's an entity that we set up specifically to look after this one mandate, given that Warehouse REIT is where our family investment is held. We're not interested in building a multi-asset management platform. We're remunerated at 1.1% of net asset value, so we're not incentivized to gear, and there is no performance fee. As I say, our alignment is through the share ownership. Just to very quickly touch on the warehouse market and how it relates to ourselves, we describe it as loosely having 3 tiers. Tier 1 is the national big box, warehouses typically between 500,000 and 1 million square feet, typically located at the M1, M6, A14 junction, often referred to the Golden Triangle. But with 80% of container traffic coming through Felixstowe Port, you can see how this is the first port of call. And then as you follow the logistics supply chain, tier 2, the regional distribution centres, operators typically having 12, buildings of between 100 and 500,000 square feet. Amazon call them fulfillment centre, and they have 26 across the UK. And then really with the advent of the e-commerce market, we've seen the last mile warehouse spring up. These are buildings typically less than 50,000 square feet, close to conurbations, and this is where Warehouse REIT focuses our investment strategy around tier 3. So our buildings are close to conurbations so that they are close to customers for supply chain, and if we have tenants who are in an assembly mode, then it's close to staff employment being a key consideration influencing how people use the buildings. So tier 2 and tier 3, these photographs are buildings within our portfolio. And again, just to give you can see the number of assets in this second line in the different size categories. Whilst our estates may be 100,000 square feet, the average unit size is still less than 10,000 square feet. So we're focused typically on multi-let estates. 78% of our portfolio is multi-let, and so a typical estate might be 100,000, 150,000 square feet, between 10 and 20 different units, probably built in the 1980s, 90s or 2000s, with a diverse spread across the UK. Just to give you a quick flavour of the top 10 tenants, top 10 assets, you can see locations such as Northampton, Glasgow, Gloucester. We're all close to motorways, M1, M8, M5, M6, Nottingham on the M1. So what we term economically relevant locations and responding well to CapEx. Sorry, top 10 tenants, just by way of example, we have no concentration of a risk around a single covenant. Our largest tenant, John Lewis, actually have 2 buildings at Northampton, rents of £575, and they've been there for over 20 years. Really interesting to see their trading stats in April. They were achieving 80% of normal turnover just from their internet presence without any department stores being open. So just demonstrating how important these warehouses are for the continued multi-channel delivery of that business. Amazon, our second biggest tenant, 4.5% in 3 separate buildings. Direct Wines is part of the Laithwaites group, and then thereafter it's pretty much 3% or less per tenant, so no single exposure. The company has a year-end March, so we, in the 2nd of June, reported our year-end to 31st March 2020. Just to pick out some of the highlights, we raised 76.5 million of new equity in April last year, successfully deploying the capital ahead of programme and ahead of budget, yielding 7% net initial yield. So we continued in the period also successfully letting new space, achieving rents 8%, just over 8% ahead of the valuer's estimated rental value. ERV, estimated rental value, is the market value as of today, which is independently assessed, as I say, by CBRE. Occupancy levels continue to grow, and we also refinanced the portfolio, which I'm going to leave Peter to talk about together with the robust financial performance. And the other piece that we mentioned that I would like to highlight at the year-end numbers is that we have continued to have a pipeline of opportunities, and therefore we have referenced an intention to raise further capital. And we've also made a statement that we continue to target a dividend for this current financial year ending March 21 of 6.2 pence. With that, I'll hand over to Peter.
Thank you very much, Andrew. If you can just move on 1 slide, please.
Sorry.
And back, thank you. Yes, I don't intend talking in detail to these numbers, but where I would draw your attention is our adjusted earnings, which increased 48% in the year to March 2020 to 15.6 million, up from 10.6 million the prior year. We paid dividends in the year to March 2020 of 6.2 pence. And one thing that is worth noting is that we pay our dividends quarterly. Since IPO, we've paid quarterly dividends of 1.5 pence, and those dividends were increased from 1.5 pence to 1.6 pence in December last year. We basically raised some money in April last year. We raised £75 million. We applied some debt to that. We fully invested that 125 million in a series of high quality assets with great asset management potential. We minimized the cash drag. We were fully invested by September last year. We were still able to cover our dividend in the first half of the year. So the period April to September last year, we had earnings of 3 pence. We had dividends of 3 pence. But being fully invested by September, that meant that we were primed and fully invested and ready to make asset management gains on the portfolio. And we were able to increase the beat rate, the run rate of the business, from 1.5 pence per quarter to 1.7 pence per quarter in terms of earnings. So we raised the money. We said we would do so only if we enhance shareholder value. And we enhanced shareholder value by increasing our dividends per share from 1.5 pence to 1.6 pence and the earnings from 1.5 pence to 1.7 pence. The dividends for last year were paid 2 1.5 pences and 1.6 pence, and the final dividend is paid actually in 2 weeks' time in July. The other point that I would mention on this particular slide is our gearing. Our loan to value 40.2%. Typically, we like to keep within the 30 to 40% range. This was at the top of the range. We've been extremely comfortable in that range to date. However, given the COVID environment, we will actually move that down lower in the coming year, and our aim is to be nearer 35%, which we feel is a more comfortable, more conservative place to be going forward. Sorry, yes, the only thing I would mention on this slide is our cost ratio. Our cost ratio continues to improve. It improves from 29.4% to 27.1% in the year to March, and it will continue to improve. And our target for this year is to get close to 25% and then better as we scale the business and leverage off the fixed costs in the business. This slide is our balance sheet. You can see our EPRA NAV there of 263.1. The point I would make here is our net borrowings. We had 181 million of debt at March. That's based on a facility of 220 million pounds. And that 181 is made up of 186.5 of drawn debt, 5.5 million of cash. The 186.5 of debt was drawn against that a 220 million facility. So we have 33.5 million of headroom. It's a new facility. It was agreed in January this year. So it's a 5-year +1 term. So we have no debt maturing until January 2025. In fact, in a year's time, we will reset it again for another 5 years. The cost of our debt is LIBOR +2%, so approximately 2.6%. And on top of that, we have a further facility called an accordion, which we can draw upon for a further 80 million with a club of 4 banks. So if the raise proceeds that Andrew referred to earlier, we will have total debt facilities of 300 million. And as I referred to earlier again, we will look to bring our gearing down from 40% to near 35%. I don't propose talking to our NAV bridge year on year, other than to say that the property acquisition costs there represent predominantly 5% stamp duty that we have to pay to the HMRC whenever we buy an asset. So last year we actually bought 135 million pounds worth of assets, and we ended up paying 9.6 million pounds to the government for the privilege of buying them. But we clawed all of that back, and together with our adjusted earnings of 6.5 pence and like-for-like increase on the portfolio of 6.2 pence. And of course, we paid out dividends. It shows 6.1 pence there. That was 3 1.5, so 1.6. But for the year, the final dividend is being paid, as I said, in a couple of weeks' time. So finally, before I just hand back to Andrew, I would say that we have a very strong balance sheet. We have facilities in place. We have cover in place. We comfortably meet our banking covenants. Even when we stress test our balance sheet, we find it difficult to breach either the interest cover or the 55% LTV covenant the bank set us. And with that, I'll hand back to Andrew.
Thanks, Peter. If I can just now pick up on the valuation. Sorry, there's an awful lot of numbers on this slide, but I'd just like to focus perhaps on 2. Our average rent per square foot is still less than £5.50. We think it's very affordable, and we look at the effort ratio. How does this rent relate to the turnover of the businesses that operate from our premises? And we can see the less than 5%, it continues to be very affordable space, and therefore we can see how rents can continue to grow when total occupancy across the UK warehouse market is down at circa 5%, and that generally means there's upward pressure on rents. The other stat I'd like to refer to is that at the bottom, the dark green, it's the £73. I don't know whether you can see my cursor or not. £73 per square foot average capital value. So the whole portfolio is valued at 450.5 million, but breaks back to £73 per square foot per capital value. Now, this is less than the cost of replacement. So again, the portfolio is valued for insurance building reinstatement purposes. It comes out at £103 per square foot. Now, I accept that that includes demolition, and you never want to under-insure. But if you try to build these multi-box schemes, then you would have a build cost of about £75 per square foot, on top of which you'd pay your professional consultants, your marketing costs, your finance, speculative finance, because you can't pre-let 10 separate units, and that's before you've bought the land and made a profit. So in other words, as Warren Buffett said, there is an economic moat constraining supply. And our contention that this is unique to our particular tier 3 of the warehouse UK market. So big boxes are much more economic to construct, probably £45 per square foot. They're often pre-let, and they're being financed in the 4-ish% net initial yield. It generates a good developer's profit and healthy land value. But tier 3 is very different. So when you drive around the motorways, you will see these big boxes that you can't miss them, but there's very few smaller multi-let warehouses. Just to give you some quick stats, we continue to focus on the warehouse. Whether these buildings are used for light manufacturing or warehousing, I'm looking at the top left-hand graph, they are the same buildings. It's up to the tenant how they choose to use the space. We've got a tail of offices, 2 office buildings left, and retail, retail warehousing, not high street retail, we'll look to sell. And we continue to focus the portfolio in the locations where we see strong occupational demand around the Midlands, what we call economically vibrant locations. We're always looking at the bottom 5% of the portfolio. That's what I call housekeeping. We make sales out of the bottom 5%, so that we continue to be accretive to the quality of what we retain. So having focused in the first half of the year on acquisitions, the final quarter we sold 14 smaller assets or non-core assets to raise 16.7 million, reflecting a 6.6% net initial yield, bearing in mind that these were our worst assets, and achieving an 8.3% premium to the March 19 book value. Just interesting that bottom left photograph, we've called it completed business plan. These are very small units, what we call workshops rather than warehouses. 800 to 1200 square feet, typically white van man and small businesses, short dated leases, 2 years. So we had the scheme fully, 67 tenants, scheme fully let, and we sold it in a low 6% cap rate at an 18% premium to book value, and we're happy that those smaller units are where it's harder to collect rent. We talked about deployment of capital last year from the fundraise. These photographs giving you an idea of what we were buying. That's the John Lewis warehouse. Well, there's 2 warehouses there actually, which are now our largest tenant, let at £5.75 per square foot. Last week, James & James, the e-commerce logistics operator, took a building of a not a dissimilar size on the same estate, paying £6.75 per square foot, a whole £1 per square foot more. So that looks as though there's an inbuilt reversion there. And then the next photograph is the Direct Wines warehouse in Gloucester. And the bottom one, midpoint, a very typical estate for us. 180,000 square feet, 20 separate units, ranging from size of 3,000 up to 30,000 square feet. And there we had some early letting success. Bought it in October, let the empty unit, interestingly, on the 12th of December. So just illustrating how people were happy to commit to new leases the day before the general election. The biggest acquisition was the Echelon portfolio, and interesting stats along the bottom, a weighted average unexpired lease term of 5.3 years, but it disguised the fact that the building in the top left at Warrington actually had a lease which expired in February of this year. And that's a photograph of the interior of the building. So when you look inside, we always talk to the occupiers before we buy. Why do they occupy the space? What are their drivers? So this is at Iron Mountain, a global brand operating in 50 different countries, I should say, 90 million square feet. And for us, they're 100,000 square feet on the M6 and 56 junction is their hub that serves the Northwest. Biggest customers are Legal Fraternity in Liverpool and Manchester, the MOD, and indeed the NHS. When you walked in the building, I immediately established there's 2.1 million cardboard boxes stacked at 5 different mezzanine levels, all hand stacked, and hence the narrow aisles in the photograph, and hand picked when customers want to retrieve documents. I asked the warehouse manager where he'd rather be relocated. Nowhere. Loved the access of the M6 and 56 motorway. So it became pretty evident that he wasn't going to go anywhere come lease renewal in less than 6 months' time. But we always have plan B, supposing we're wrong. Can we relet the building? What rent will it achieve? Roll forward, we completed the acquisition in September. We then received notice from the tenant confirming they wanted to stay. And last week we put out a news announcement to confirm that we have completed a new 10-year lease, and the rent on this building has gone from £4.60 up to £5.80. So a material increase on a 10-year fixed term. Just giving you a mix of flavour of our tenants, you can see lots of e-commerce driven occupiers, Woolcool, Amazon, Direct Wines, John Lewis, Boots. These aren't retail stores, Amazon. These are warehouses serving their online offer. Just want to flick through to some of the other highlights. We continue since IPO to track our new lettings. We continue to achieve 9% ahead of value as ERV, 16% on lease renewals ahead of previous passing rent. And that's because when the valuer looks at our estate, he can see this top left photograph. He's seen pre-refurbishment. And this is a classic case study, Whitney, outside Oxford. We call it Oxford Overspill, 12 units, 112,000 square feet. 6 of them had been let to a single tenant. Anyway, the subsidiary company ceased to operate. The tenants vacated, but the parent company still had to pay rent. We negotiated a surrender, took £800,000 surrender premium, then set about a refurbishment, tidied up the units, replaced the skylights, new lighting, etc. And now we're achieved lettings of 725, 775, compares very favourably to the £5.40 that we had previously been receiving. Another case study in Doncaster. And then we come on to reference in our year-end results the fact that we continue to look at a pipeline of opportunities, recognising that investment volumes in capital markets have turned down. It represents a buy opportunity, and hence we think we can find stock that continues to be accretive to our value. And I want to probably just stop there and give time for questions.
We have had a lot of questions. Again, apologies in advance if I don't get to yours. We probably have more than we have time for. We've had a few people ask about rents in the COVID-19 impact. Have you had any defaults, or what scale of defaults, or rearranging terms have you had with any clients?
So in the March quarter, rents are paid quarterly in advance: March, June, September, December. For the March quarter, we stated at the end of 27th of May that we had collected 94% of rents. 87% of our tenants paid the quarterly rent as per usual. 7% paid on monthly payment plans, which we agreed. 91% cash received, 3% still to come on payment plans. What I can tell you since the 27th of May is that we continue to receive rent every single day. So if we were to republicise that market, it would be higher. Of those who hadn't paid the 6% tail, 40% of that income is covered by rent deposits. So we're pretty comfortable that we'll continue to receive more rent. Where the default lies, will we collect 100%? Probably not. Too early to tell just where the final number will be. But we now look forward to the June collection. We're already working with our tenants. We collect £7.5 million of rent on a quarterly basis. We already have a material amount received because the 12% of the portfolio in Scotland, their quarter date is a month in advance. And we are talking to tenants about paying monthly where we think that will help their particular cash flow. But we've also been looking at active occupation in April, it was down at sub 50%. 2 weeks ago, it was north of 75%. And pretty much every day we've seen new activity in the portfolio, which will feed well into the June quarter payment.
You mentioned a potential capital raise in the future. Would you be minded to have retail investor participation in that, either through a platform like Primary Bid or offer through other intermediary channels?
We would definitely. We had proposed a capital raise in February, March, and had a successful roadshow, but we adjourned the general meeting and therefore the fundraise due to lockdown. As part of that process, we had indeed teamed up with Primary Bid and an intermediaries offer as well to encourage retail investors. A number of our shareholders are our wealth management community, and the underlying shareholders are a lot of ISA holders behind those, and they followed us at IPO, and we want to remain loyal to that shareholder base.
Had a few questions about the kind of the future of the warehouse sector and around robotics and automation. In mind, I've got that picture of maybe the very large, the kind of big box units. Does that filter through to where you are?
Well, focusing on the last mile delivery, multi-let warehouses, I mean, I think the first thing to say is that our buildings are relatively straightforward. They're not full of complicated mechanical and electrical services. They tend to be fitted out by the tenant. Those which are used as last mile distribution warehouses for either by Amazon or the 3PL logistics companies like Hermes, DPD, all the activity is at ground floor level. Stock comes in, stock goods come in at between 1 and 3 in the morning, are unloaded, stacked at ground level, picked in the morning between 6 and 7, and then they go out on the distribution. So often during the day they're quite empty. So, but other people invest significantly more in the buildings. But one of the resilience to our cash flows is the diverse occupier base of our customers.
And this might be the final question we have time for. You mentioned relatively early on that most of the units that you own were built in the 80s, 90s, early 2000s. Is for future acquisition, I guess it's the potential opportunity for the estate, how many units there are that fit into your criteria available in the market, and also are they not being built now? Is that why they are from that time?
That's exactly it. Because of this equation I've given you around we are buying at less than the cost of construction, then there is no incentive for the private sector to build these units because it's so difficult to make a profit, which is in contrast to the big boxes, which are viable to build because of the reduced construction costs. However, the market turns out over about 8 billion of stock per annum. This is just the UK warehouse market. We screen about 2 billion, constantly looking for the opportunities that we think will deliver standout performance above market forecasts. It is not a screen-based market. It is about contacts. It is about reputation, and that's why we've been able to again identify a pipeline. Much of it we had under offer in exclusivity pre-lockdown. We continue to work with the vendors of that pipeline, and hence our interest in a potential raise. We said at IPO that we'd be fully invested within 6 months. We did it. Last year, we said we've been fully invested within 6 months, and we achieved that. So we'd be very confident about a quick deployment of any capital from a fundraise.
Lovely. Thank you both very much indeed, gentlemen. I'm afraid we are going to have to finish there. We have had lots more questions. Again, apologies if I've not had a chance to ask your question, but please do continue to send them in, and thank you very much for doing so.